One of my clients recently sold a piece of real estate, and this triggered a high six-figure long-term capital gain. Now, he wasn't exactly thrilled when I mentioned that a piece of that was going to be subject to an additional 3.8% income tax. What I had to explain to him, and what I'm going to explain to you today, is what the net investment income tax is and when it comes into play. Let's get going. The net investment income tax, which we're going to just refer to as NIIT for short because it's kind of a mouthful, was born out of the Affordable Care Act back in 2010. And essentially what it is an additional 3.8% income tax targeting passive income for what was considered higher income households when the law was written. Now, to be more specific about the income levels at which NIIT comes into play, we can reference the table up on the screen. Now, I don't want to get too technical here, but these figures or these thresholds are based on a figure known as modified adjusted gross income. For most taxpayers in the U.S., this is going to be the same as adjusted gross income, but this is why you need to work with a tax professional to make sure you get this right. Nonetheless, just to give you some sense here, for married filers with modified adjusted gross income of $250,000 or more, and single filers with modified adjusted income over $200,000, and you can see it for the rest of the different filing statuses, this is when that extra 3.8% tax would come into play for certain types of income. Now, the clients that I see that are most commonly affected by NIIT, again, are those that generate a significant capital gain, which pushes their income up above those income thresholds that we just looked at. But I really want to be clear here, NIIT is targeting basically all types of investment income or passive income that is not inside of a retirement account. And to be specific, we can look at the actual IRS form 8960, which is up on the screen here. This is for doing the calculation for net investment income tax, and we can see what they are targeting here specifically. So on line 1, they're looking for taxable interest, obviously from bonds, dividends, non-qualified annuities, in other words, things not held inside of a retirement account. If a taxpayer has rental properties, of course, there's capital gains and so forth. So my point here, and I just want to emphasize this, it's any combination of all these different types of investment income above those thresholds is what is subject to this additional tax. Now, for the last part of this discussion, let's look at 3 hypothetical examples so you can see how the net investment income tax interplays with different combinations of income. In this first example, let's take Charlie and Nancy, and let's assume that they're 60 years old and they recently retired, and they're going to live off some stock that Charlie accumulated through his career. They're just going to sell stock off and defer Social Security. So that means in 2023, their only income was $400,000 of capital gains from these stock sales. And what that means from a net investment income tax perspective is, again, their gross income or their modified adjusted gross income for this calculation is going to be $400,000. But for married filers, again, remember, the threshold is $250,000. So it's only investment income above that threshold that is going to be subject to that additional 3.8%, which of course for them means that $150,000 of their income, of their capital gain specifically, is going to be subject to NIIT. Now, example 2, let's assume Charlie and Nancy are still working. So their income composition is a little bit different. This year for 2023, or in this hypothetical example, their combined salary or W-2 wages are $300,000, and they also did end up selling some stock throughout the year, which generated a $50,000 long-term capital gain. Therefore, their adjusted gross income, or for the purposes of calculating NIIT, their modified adjusted gross income, is $350,000, which of course means they're $100,000 over this threshold. But here's the important point. Only $50,000 of the excess over this threshold is considered investment income or passive income. And thus, that $50,000 is what is going to be subject to the net investment income tax. So in this example, I'm trying to distinguish here the difference between ordinary income or working income and passive income or investment income, which is what the NIIT is ultimately targeting. Now in this final example, let's assume Charlie and Nancy are well into retirement. And they have a mix of different income sources now. They have $60,000 of Social Security benefits that are taxable, $120,000 of IRA withdrawals, and a $100,000 long-term capital gain for 2023. So that, of course, means their gross income for the year is $280,000, and their modified adjusted gross income would be the same number in this example. This, of course, means they're $30,000 over this threshold, and thus $30,000 of their investment income would be subject to that 3.8% net investment income tax. Now, the last thing I want to touch on here is the tax rates for long-term capital gains. And notably, up in the table here, what we're looking at, these are the rates for 2024. We've been mostly talking 2023, so I should emphasize that. But real quickly, this table, we have the income thresholds for individuals on the left-hand side here, joint filers on the right, with the various tax rates in the middle. Now, what I want to convey here is these rates, particularly the 15% and 20%, are a little bit misleading, and I think this kind of is what can be confusing to people. In reality, as we learned, the way that the math works out with NIIT, again, it's based on gross income. If you're a joint filer and you have a capital gain over $250,000, it is going to be subject to this additional 3.8. So we really could add another tax bracket in here, which would be 18.8% for any capital gain over $250,000 for joint filers over here. And we actually could just cross out 20% and change it to 23.8, because based on these thresholds, any gains taxed at this rate is also going to be subject to NIIT, just based on how the math works out. Now, I hope this isn't confusing. I just think this is another way for people to understand and visualize the tax rate at the federal level, at least, that they're going to be paying on long-term capital gains. Wow, that is another technical tax topic, and frankly, it's kind of a good example of some of the work that I do for my retirement planning clients. You know, retirement planning isn't just about the investment portfolio or creating an income strategy. It's also about managing the tax implications of those things as well. And that's the stuff I really enjoy doing. If you want to reach out, please head over to my website. You can send me a message directly through the contact page. Happy to see if I can help. As always, I want to say thanks for watching. I hope we'll see you on the next one.